All right, welcome to Venture Roadmaps. We're going to take you through what you need to know about how to launch a venture capital fund and firm in 2023. And the reality is right now it's sort of mid-July. You can still get it done and closed and actually complete investments in 2023. If you wait, though, even a matter of a few weeks, it's going to be pretty difficult for you to get it done in 2023. You're going to be really slipping into 2024. So if you want to have a vintage 2023 fund, now is the time to start, literally right now. And so it's a good time in general to start, though. And this is a very important point to make because venture capital is counter-cyclical. So while the rest of the world is still in some sort of turmoil, right? There's generally economic jitters around the world. Not only is venture capital in full recovery, but also because the rest of the world is facing jitters, it's considered worldwide one of the best times in history to invest right now. Okay. And that's because the turmoil in the world is so great that it makes now such a good time. And in fact, I'm going to talk a little bit about that. And again, we have a dedicated event about this next week, but I'll talk a little bit about it right now. So on one side of the equation, on the investing side, the startup valuations are lower. And there are less startups. And those two things make for a great investing climate because in boom times, valuations are very high and a good investor might have to see 100 to as many as 1,000 companies to make a single investment, okay? But when there are less companies and the valuations are lower, investors don't maybe need to see 50 companies or couple hundred companies to make a single good investment. Plus that single good investment will have a lower cost basis because the valuation is down. So cost per share will be lower. And therefore it's a lot easier for the investor to make a large upside. In addition to that, the nadir of LP commitments into venture capital firms, according to our data, was in December of 2022. This was the low point of investing in early stage emerging managers. And we've helped start about half of all new and emerging managers or new managers, I should say, in 2022. So I would say our data is pretty good. It's not perfect, but it's certainly better than PitchBook and a lot better than any of the other rating agencies because they don't have 50% of the firms as part of their panel or surveys or whatever. So the nadir appears to be December of 2022, and June of 2023 was our single best month in history for commitments into venture capital firms. And July is looking to be another strong month, possibly as strong as June, maybe even stronger. And July is traditionally a very slow month for venture capital. So not only has it come back, not only are we at all-time highs, but even traditionally so slow periods of limited partner commitments into venture capital funds are at kind of unusually high levels and not falling victim to traditional summer slowdowns. So it's not just a good time right now to start a fund, it's a great time to start a fund. And almost every investor that I talk to says that 2023 will be one of the best vintage years in history. And vintage year is the year that a venture capital fund gets started. And why do we care? Why do we care about helping you? Why are we doing all this? We want to transform venture capital into a force for good in the world. Right now, it's not a force for good in the world. It funds things like Facebook, which become Meta, and various things that, you know, the influence on greater society is definitely questionable. What we want to do is back ethical venture capitalists that are funding solution to the world's problems, okay? Because the world is on fire. We are in trouble. We need to fix the problems of the world now, not tomorrow. And so the way I look at a future is by 2030, because we're now directing capital at things that matter, we can reverse climate change, not stop climate change, reverse it, okay? We can increase biodiversity, which right now we're on a biodiversity cliff, okay? And so we're reducing biodiversity. We're going to get to a point where now roughly half of the biodiversity of the planet has been eliminated by human beings. Well, I want to start seeing us increase it so that we can bring more biodiversity back to the planet. And then this whole transformation will be powered by renewables rather than fossil fuels, which frankly, by their name alone, will run out. And, you know, they're expected to run out by 2050. Some models have it there a little earlier, maybe a little later, but let's just get off of them by 2030. And so let me tell you now how you can start a venture fund to contribute to this solution. And we'll get started with venture roadmaps. Okay, so there are 5 steps. And remember, if you have questions on anything, pop it into the Q&A. So step number 1, you have to draft a compelling thesis. And I'll go through all these in more detail in a moment. Step number 2, you got to build a strong track record, and there are hacks that I'm going to give you if you don't have the track record right now. Step number 3, you got to create your materials. Step number 4, you've got to pitch a lot of leads without general solicitation, and I'll talk about that as well. And then last but not least, you're going to have to run an efficient closing process, especially if you want to get the fund done in 2023. So let's start with the thesis. We have come up with the universally accepted one-sentence pitch template. It's like, or thesis template. It's like your Mad Libs for a venture capital fund thesis. And it's right here. So fund name is targeting a certain amount of money for a stage, such as seed, pre-seed, etc., in the country or city where you're based, to back companies in a certain geography, in a certain market and sector with secret sauce. And I'm going to go through each of these in more detail, but I want to start with the fund size, okay? Every new manager gets into venture capital and they're like, I'm going to launch a $30 million fund. I'm going to launch a $50 million fund. I'm going to launch a $100 million fund. No, you're not. Okay. You're going to launch a $5 million fund, a $10 million fund, or maybe a $15 million fund. Maybe. Okay. It's just not realistic. Okay. Now, there are some people who can do a $30 million fund, who can do a $50 million fund, and who can do a $100 million fund. These are the unicorns of VC, right? They've usually been a venture capitalist before. They usually have an incredible track record, and they usually know a lot of people with lots of money. That's the profile. So if you've been a VC and you've been a top decile VC, and you know lots and lots of rich people, you can probably do a $30 or $50 million fund. For everyone else, that's just not realistic. And I can regale you with stories, okay? A dear friend of mine, top decile VC, launched a fund, said, I'm going to do 10, but I'm really going to shoot for 25. Unfortunately, it got leaked in the media that he was doing a $25 million fund. He's done raising the fund. He put everything he could into raising it. This is a top decile former VC, 11.8 million. Okay. Another friend of mine, also a top decile VC, knows every rich person in the world, went out there, I'm doing $160 million fund. I'm like, dude, that's a lot of money. I don't know if you can do it. He then was like, oh my God, this is way harder than I thought. I'll go a $60 million fund. And I think he's finishing right now at 50 something. He didn't even get to 60. It's better for you to say 5 and close on 10, or say 10 and close on 15, or even close on 20, than to say 20 and close on 18. Because if you don't get to your target, you just look bad. So I can't stress this enough. You're just going to look really bad if you shoot high and miss the mark. And it's a lot harder than you think, because new managers have a scarlet letter on their head. No professional LP wants to deal with you. I'll talk to you about how to find LPs in a moment. And in terms of your thesis, you want to focus on one stage. So this is a survey of LPs here and what they want, okay? So 71% of LPs want venture capital, and these are the bigger LPs, right? But smaller LPs, it's even more. 71% of the larger or bigger LPs want you to focus on one stage, okay? So you could say, no, I'm going to be multi-stage. I'm going to do early stage. I'm going to do Series A and Series B. Well, okay, now you've just cut the number of LPs to 29% that you can pitch. So if you have 100 LPs that you know, 29 will be interested in what you're offering. That seems pretty dumb, right? When you want to go after 71 versus 29. And then a lot of people are like, look, I want to be a generalist. It's even worse. Okay, so I'm going to just invest in anything that I find. Well, great. Then if you have 100 LPs, only 18% of LPs want generalist investors. Everyone else wants specialists, okay? And I'll talk about geography for a minute, because this particular survey bundled them both. First of all, you want to specialize in an industry or segment. I'm still not sure, right? Somehow Siri thought I was talking to her. My watch decided to reply. So 18% want generalists. Everyone else wants specialists, right? Specialist means industry or particular segment, or even like a vertical, but it's not like anything and all SaaS. SaaS is pretty broad. So the more specialized you focus, the more LPs you're going to reach. And let's talk about geography. When an LP invests in a fund, it's a pass-through vehicle. So that means you're just bundling their money and giving it to a company, but they own a pro rata piece of that company based on their contribution to the fund, and this is managed in their capital account. So if you invest in Africa, and you invest in Europe, and you invest in North America, they have tax liabilities and other obligations in Africa, North America, and Europe, etc. No LP wants that, right? No, nobody wants that. They may want just Africa, and even Africa's an enormous continent, right? There's North Africa, there's Francophile Africa, there's Southern Africa, Sub-Saharan Africa, blah, 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 right? So LPs want to know where their money is going to be invested, because they have tax and other obligations in those regions when you make the investment. So you say, I want to invest everywhere in the world, and I promise you, you're going to get very few LPs that want to do that. LPs want specialized investment. So going back, you want to focus geography, a focused sector and market, a focused stage, and a small fund size for your thesis. And secret sauce is really tricky, so I'll answer questions about it in the Q&A if you want to know how to construct a secret sauce. But basically, it's why are you uniquely suited to launch this fund, and you got to support that with data. And I'll talk about your track record right now. So if you don't have data, so obviously the thing that every LP wants to see is, I've invested in, I don't know, 5 companies before in this market and segment and stage, because it had your track record in your fund has to match the thesis, right? So your personal track record towards the fund has to match the thesis. So if you don't have a track record of investing, you can talk about like, and we have a whole, and maybe Niels, you can post a link to the track record article so everyone can check it out. We have a whole article about how to quantify your track record, but I'm going to give you a hack, okay? And this is a pretty important hack. You want to build a deal warehouse that either, if you don't have the past track record, start making investments right now, right? There's no time like the present. So if you're actually going to start a venture capital firm, and let's say you're going after SaaS fintech at the pre-seed stage, you can start making $25,000 investments in the pre-seed stage, assuming you have the money, and then you can warehouse those investments and transfer them into the fund, and then that will eliminate your GP commit of 1%, because instead of committing 1% of the fund size to the fund in money, you can commit 1% of the fund size in equity that you've invested in. So you can literally build a track record right now. And if you don't have the money to make the investments to build the track record in what's called warehouse deals, and maybe you could share the link on warehousing deals, Niels, as well, then what you can do is find some companies that you will invest in, future investments, right when the fund closes. And you can do that now. So if you don't have track record because of previous investments, you can start investing now. If you don't have the money to start investing now, then you can find investments to put in the fund. So you can build a track record if you don't have one. And even if you have one, you should be doing these things. And let me just be super clear. Thesis aligned deals that you've done that have markups, so they have rounds that have come in later that increase the valuation of the businesses, get limited partners excited. If you've done them in the past, it gets them excited. If you're doing them in the present and transferring them into the fund, it gets them excited. And if you have some deals that have a high potential of getting marked up, that gets them excited as well. Deals get limited partners excited with thesis aligned deals. So it's one of the single most important things that you can do. Now, I want to talk about your materials very quickly. This is less important than and that's why it's number 3. So number 1 is the thesis. Number 2 is obviously the deals, and number 3 is the materials. You can start pitching LPs without materials. In fact, many of you should start pitching LPs without materials. And then what you do is you just talk with them about your thesis. You talk with them about your track record. And a lot of times LPs never look at your materials and commit. It happens all the time. I would say that the best closers we've ever seen don't use a deck. They don't use a fund overview. They don't use a fund model. They don't even use a data room. Now, that might be for 90% of their deals, or that they close with LPs, 90% of their LPs. The reality is some will require it. So you're going to need it, okay? And here's what you need: a fund presentation, a fund overview. Fund overview is usually like a page or 2 that puts the presentation into words, a model. You can download models from Taylor Davidson. And you're going to need some sort of data room with all your references, materials, etc. I want to focus for a minute on the fund presentation. These are the slides that you need in the left column, and they're optional slides in the right column. So the average deck is about 13 to 15 pages to raise a fund for a new manager. Emerging managers, it can be longer because you may talk about fund one or you put some additional slides, but basically they're not very long. And what you do is you take your thesis, you put it on the first slide after the title, and then the rest of the presentation basically explains why your thesis is a good idea and why you are uniquely suited to do the thesis. And so what I like to do is take a copy of my thesis, shrink it down, and paste it on every single slide in the deck, and make sure that every single slide in the deck has a defensible point relating to the thesis. And if there are words that don't relate to the thesis, or comments that don't relate to the thesis, or charts that don't relate to the thesis, I delete them, because everything must support that thesis. Okay? And we'll take you through this in the program. Happy to answer questions about decks later on. And now you're going to have to pitch literally hundreds of leads. So the average investor will take between 200 and 400 limited partner meetings to close a fund on the low end. And if you're in a developing market or in a difficult field, it could easily be up to 1,000. All right. Now, just do some math there. 1,000 pitches is about 1,000 hours of just pitching and then prep work and everything. So that can be very long. Even 200 is enormous. So it's a big undertaking. I'm going to take you through how to do that in a moment. So you have to avoid general solicitation. Okay. In Europe, if you generally solicit, you face jail time. In America, if you generally solicit, they will ban you from fundraising for 10 years. Okay. And that means at bake sales for your startup, no more fundraising for you for a decade. So you're you're out of the world of entrepreneurship and venture capital for a decade. All right. And generally soliciting means nothing about your fund or firm in the public. You could say, I'm a general partner at this fund, and as long as there's really no information about the fund online, that's fine. But once you start talking about your thesis at all online, if there's a website, if you post, I'm looking to raise money for my fund, we're doing AI, all that is not right. And you're like, but I see people do that all the time. Okay, so first, there are a lot of stupid people in the world that break the law, right? You know, that's why there's jail, and that's why these rules exist. And it's, you know, that doesn't mean you should do it, right? Like, oh, he murdered someone, I want to murder someone too. It's like, no, don't do that. So yes, there's a lot of people in the world who break the laws. Now, there are some exceptions to the laws as well, right? But those exceptions suck. So you really do not want to do them. In order to generally solicit in the United States, now there are no exceptions in Europe, so you can't do it in Europe at all, but there's some exceptions in the US. Every single investor that comes in has to fill out extensive information about their personal finances to prove to you that they are accredited. Now, how many people do you think want to do that? Not many. Do super rich people want to do that? No. So basically what happens is you can go out and generally solicit in the US as long as kind of the poorer side of rich people who don't really care about sharing their personal finances are your only investors, which is not a great audience to go after. So by default, you see like super tiny funds do this with people that have good social networks that know lots of rich people. But it's generally not recommended because you're not going to get any bigger LPs to do it. So here's how you do it, avoiding general solicitation. Number one, you just build your network. You should be posting about venture capital a lot. And if you don't know what to post, just take something that, let's say I post on LinkedIn and repost it with commentary. I put a lot of general points about venture capital up, as do many people. Repost stuff from others and put your own commentary on it, and you'll start building your brand and connections and your network in venture capital, which will include limited partners. Then you start pitching your confidants, people you know well, your first degree connections, and getting feedback and commitments from them. And then once you know your pitch is good and you're able to get commitments, you reach out to connectors. These are people that you know that know rich people, because you'll have now a network of venture capitalists in venture capital, which will include limited partners and potential deals. And you'll say, oh, I know this potential limited partner, but I don't know them really well, so I need an introduction. So I'm going to use a connector. This person I know really well knows this LP, and I'm going to get them to make an introduction. And you don't have them introduce you about your fund. You have them introduce you because you're working on something interesting. You get to know the limited partner, and then you pitch them. That's the basis of general solicitation. You need to know the person first and have a good, reasonable belief that they are wealthy, that they are accredited. And if you know them and you know they're wealthy or believe they're wealthy, then you can pitch them. And this is not hard to do. You just get on a phone call with them, get to know them, and then pitch them afterwards in another meeting or a follow-up meeting, right? It's not that hard. It's a little more work, but then you comply with the law. Okay. And once you start getting interest from LPs, you'll start coming up with, oh, you know, wealthy tech execs or exited founders or bankers or whatever. And Niels, maybe you could share the article on LP archetypes. They're going to start liking your fund. You'll be like, wow, all these bankers like my fund. Maybe I should pitch more bankers, right? And you will develop LP archetypes, and you will start going after those archetypes with the connectors, with other LPs that have come in, and it will get easier for you to get more commitments once the engine gets going, and you should be pitching about 20 LPs per week. When an LP is interested, we have a system to hard circle them with something called a pact, which is a non-binding letter of intent to invest. And why pacts are mission critical for fundraising is if an LP says to you, I want to invest, there's only about a 10 to 25% chance that they will actually invest, because it usually takes you months to close, right? So let's say I say, oh, you know, yeah, I'll invest. Great. 3 months later, you come back to them with the paperwork. They're like, oh, I bought a house, or I've moved, or I got fired. I'm not going to invest anymore. So verbal commitments are what we call a soft circle. What you want is hard circled investments. When someone signs an LOI to invest, their likelihood of closing goes to 50 to 75%. And sometimes even higher, okay? So the act of signing something that they're going to invest, in this case a pact, increases the probability that they will come in by at least twice and sometimes as much as 3 times. Okay. So you want them to sign something to hard circle, and that's a critical step in the process. And once you have 10% or at least $1 million or 10% of the fund size committed, whichever is higher, right? And not before. And that's not committed soft circled, that's committed hard circled. You start a closing process, and you want to get the closing process done pretty fast in about 2 months. I wish I could tell you that closing was, that's fast for closing, by the way. A lot, like, just to give you a sense, getting a bank account can take you 2 to 4 months. It's not a normal bank account. You need a PEVC bank account. And they're going to ask you all sorts of AML questions. You need an AML policy, blah, blah, blah. You need all of the entities set up. And then the bank will review your legal agreements. And I can just tell you something, banks reviewing legal agreements for your tiny little fund is not a top priority. So it takes months. So you got to find vendors that can move quickly. You've got to engage your limited partners. When a lawyer sends you a 200-page agreement that's basically written in some, Sanskrit, as far as you're concerned, you got to try and read it fast. You got to set up the entities, set those bank accounts up, secure the signatures, and then get to a capital call. And you got to do that in 2 months. And it sounds like a long time, but I'm telling you, 2 months is wicked fast for a closing, but that's what you want to try and do. The fastest you can do it, just practically speaking, is 1 month. Very fast is 2 months. So the absolute fastest is 1 month. Very fast is 2 months. And if you're in Europe in some slower areas, it can take a year. Singapore, a year. Europe, 6 months to a year. So think about that. Once you get all of your commitments ready and you're ready, I'm ready to close. It could take a year if you're in Singapore or Europe to close. So now we have programs at VC Lab and Dessel Group, the parent company, that can get it done in this faster time frame. But I just want to manage your expectations that if you don't work with fast people who know about getting things done fast, it's going to take you a long time. And don't believe any of the BS from these vendors. I would say the fund formation vendors fall below used car salesmen in terms of trust and quality. They are the bottom of the barrel. They lie to your face. I'll give you an example. Carta, the engagement letter, which are like, sign the engagement letter. If you don't want to work with us, you don't have to work with us, has a $75,000 cancellation fee. Okay, so if you're like, oh, I don't want to work with Carta, or I don't want to launch your fund, or I want to go do that, $75,000. It's hidden in the, and it's hidden. Okay, and they charge it. Like, who the hell does that? Like, oh, you signed something and we didn't do any work, $75,000. It's like, what? Yeah, so these people are the bottom of the barrel, so you have to be super careful. Okay, and so what you will set up in this process is a 3-entity vehicle, and this is for most domiciles or jurisdictions. In Canada, it's actually 5 entities, but you have a Manco at the top, which owns the brand. You got a GP in the middle that distributes the carry, and then you've got the fund at the bottom. And every time you launch a new fund, you create a new fund at the bottom, and you may or may not create a new GP, depending if you change the carry allocation, okay? And so that's what you're going to be setting up. And that's also why the banks take a long time, because they have to review the agreements for all 3 entities, right? And make sure they make sense and comply, et cetera, et cetera, et cetera. So how can VC Lab help? We're the leading venture capital accelerator by far. We accelerated 50% of all new venture capital firms worldwide in 2022. It's 100% free. We have an 84 net promoter score, which means we're, world class. The program lasts about 4 months. We have cohort 12 starting shortly in August. And the deadline to apply is August 7th. And we're going to get you done this year. We're going to get you done this year. If you start working on your thesis now, you'll have a little bit of a head start, and you'll definitely be done this year. So if you can't get done by December, what I mean closed and launched, then you may slip into early 2024. But our goal in cohort 12 is to get as many people formed and launched as possible in 2023, just because it's a fantastic vintage year. We offer a full curriculum on how to do it, an amazing community with some of the best new managers in the world, the top mentors in the world, helping you every week. We have a whole tech stack to run your fund on that's free. We have a formation and back office team that will set up your fund in 1 or 2 months on the faster level and is not going to have a $75,000 cancellation fee, no cancellation fees, no BS. And we'll do all the administration and just help you win, because we're in it to make the world a better place by launching these funds that have a vision for the future that's better than where we've been in the past. And so again, the deadline is August 7th. If everyone here wants to apply, great. If no one wants to apply, great. I mean, we already have a pretty epic number of applicants, and I think we may even be halfway full, Niels. I accepted a bunch of people yesterday. I am the only person in the company that can accept people. So we have a whole team that reviews and helps and scores, but I do the final reviews and accept everyone because we take this seriously. We want to make the world a better place. So let's jump over to questions. Have you been filtering them? If anyone has questions, please pop them in the Q&A. Niels, your job is to read them. My job is to answer them today. But again, do me a favor. Don't be shy. We got about 15 or so minutes. I might be able to run over. Let me check my calendar. But people tend to save the questions for last, and that's not great. Let's rock. I can run over a little bit. Get those questions in. Niels?
Okay, first question comes from Timothy. He is asking about pitching. He's a bit stunned by you saying you need to schedule calls with 1,000 LPs per year. Says it seems unbelievable and impossible. Adeo, any comments on how to do this? And
yeah. So look, most folk, as I said, there's a range. So for the people in developed markets and in mature markets, it's probably 200 to 400, maybe 500 at the most. In developing markets, Africa, et cetera, it's definitely 600 and above, up to 1,000. And nobody closes a fund in a year. All right. So the way fund closings work is you do a first close, and then you usually have 18 to 24 months, 12 to 24 months, but most people pick 18 or 24 months to close on the rest of the capital. So let's say it takes you 6 months to the first close, then 24 months to the final close, which would be a long closing cycle. You're at 30 months. So you're going to take about 30 months to pitch 1,000 LPs in a developing market, like certain parts of Africa, et cetera. Most people won't need to pitch 1,000 LPs. As I said, it will be 500 or less. But unfortunately, most people still need the 30 months. So now you're pitching 500 LPs over 30 months. And you know, how you do it is you hustle. Basically, you will, for the first year to 2 years of your existence as a venture capitalist, spend 90% of your time on fundraising. That's the reality. So if you think, oh, I'm going to be like investing, no, you're not. You're going to be fundraising 90% of the time for the first 12 to 18 months. Some of you will be in the 24-month range, and some may be as high as 30 months. I'd say most of you will get it done in 18 months or less, and that's 90% of your time. All right, let's move to the next one.
Next question is also about fundraising as a new manager. Jasmeet is asking, how do you reach out to LPs without using social media? And what is the best approach?
We talked about it. You build your network, right? You'll start getting people who are LPs that follow you. You're gonna have to research your network. You have to find LPs through research. You're gonna have to build LP archetypes. We posted an article in the chat on how to do that. And then you're gonna have to use connectors, people that you know that know the LPs you want to talk to. So if you and then you're gonna have to meet the LPs and actually get to know them and then pitch them, right? So that's the sequence: research, connector, friendly meeting, pitch, right? And so imagine you're gonna have to do that 500 times, right? You know, that's not 500 hours in that case. It's you know, a lot more. And that's why it takes a long time to close the fund for a new manager, and 90% of their time for months. All right, let's keep rolling.
How do you go about warehousing when your fund is not set up yet? Do you invest directly from a personal account or set up a temporary vehicle to make the warehouse deals?
You yeah, no, you never set. Temporary vehicles were really hot. That's why companies like Assure, who went bankrupt, and others came into existence, but they're really a waste of time. Okay, do not set up SPVs or anything like that. Okay, they were popular, they were like flavor of the moment, it made no sense. Don't do it. You invest personally, and you personally transfer that investment into the fund, and that transfer covers your GP commit. General partners are expected by LPs to commit 1% of the fund in cash following a capital call structure. But you can, instead of investing in the fund cash, you could put equities that you've bought into the fund in lieu of making the investments, and that fills your GP commit.
Okay, next up we have Adira Mola, who's asking what's the most appropriate way to pitch to VCs or investors? Do you use a memo or deck in first contact?
And you can't send materials out, okay, guys? There's no sending of materials. Maybe put the general solicitation guidelines in the chat. General solicitation, you cannot send materials at all. In fact, you can't write an LP, hey, I'm doing this fund, you want to meet? You can't do it. That's generally, you're sharing information with someone that you don't know, and you're not sure they're wealthy. You must know them, and you must be sure that they're wealthy before. I mean, I'm oversimplifying the rules, but that's basically it. And so if you don't know them and you're not sure they're wealthy, you can't tell them about your fund at all. You can't put a little teaser snippet. You can't put a deck. You can't put a one sheet. You have to get introduced by a connector. Hey, I want you to meet so-and-so. He or she is working on something very interesting. Take a moment, and I'd love you to hear what they have to say. Hi, my name's Adeo. What are you up to? Oh, you know, I'm doing this. Well, I'm very interested in AI, and you get to know them. You have conversations with them. And after you establish the relationship with them, you do another meeting where you pitch them. And after you pitch them, if they want, you send them materials. But generally speaking, as I said, almost nobody I know really uses material for pitching LPs or needs material to pitch LPs. Like 1 in 10 LPs will even ask for materials, right? Because again, you have to get to know them, and then you have to pitch them. And usually you're pitching them just conversationally, describing what you're up to, your plans, etc. You're not going through a deck. You're not sending them a deck. 1 in 10, maybe 1 in 8, or 2 in 8, 2 in 10 will ask, right, for materials. A lot of times, people don't have the materials, so they'll just say, hey, we're finalizing the deck right now, let's just jump on a call. So you don't need either of them. Okay.
T loves the fact that we're talking openly about VCs being unethical and broken, and that we want to make the world a better place. He's asking, are there any more materials about this, and do we have any stuff that he can read?
Look, I mean, you don't. There's not a lot of stuff written on in the world about VCs being unethical, but they definitely are. Okay, there are no ethics in venture capital, period. Okay, we wrote the ethical guidelines of venture capital, called the Mensarius Oath, and there are no ethics. So outside of the Mensarius Oath, there are no ethics. And VCs do unspeakable things to founders every day. They do unspeakable things to angel investors and other investors every day. They fund things that make the world a worse place every day. And, you just need to talk to a founder in the industry, or, probably the most abused group of founders are female founders. They get sexually solicited all the time in places like Europe, where the VC community is just notoriously horrible. So it's not hard to find the stories of VC abuse. They're rampant. Okay, rampant. And so we're the, now look, we did 50% of all funds last year, so we've stopped the venture capital abuse. But the sickness of the venture industry is not just limited